Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Old Dominion Freight Line, Inc., ODFL. We've spent a lot of time analyzing the operational fortress they've built and their specific strategy right in the middle of this prolonged industry downturn. Our mission for this deep dive is pretty comprehensive. We're synthesizing the entire investment thesis based purely on the material you've provided, focusing really intensely on ODFL's ability to navigate this economic storm and, what that readiness means for future returns.
And to cut right to the core conflict here, the investment thesis is, it's incredibly clear. ODFL is leveraging its industry-leading 74.3% operating ratio and its fortress balance sheet to execute a counter-cyclical capacity expansion. They're positioning for nonlinear earnings expansion once this prolonged freight recession, which we can see in that staggering 9.0% drop in LTL tons per day, once that finally inflects.
Okay, that's a dense statement. It layers current pain over, massive future potential. Before we get lost in the numbers, let's quickly define what we're talking about. When we say operating ratio, we mean the percentage of revenue that goes to operating expenses. So lower is better.
Right, exactly. ODFL 74.3%. It's like saying they spend 74.3 cents to earn every dollar. That is just world-class efficiency.
And that tension you mentioned is framed by that 9% drop in tons per day. That's the recession hitting them.
It is. But the fact that they can maintain that low OR despite that volume drop, that's the first real hint of their structural advantage.
So let's start there. What exactly gives ODFL this unmatched competitive moat? Because it's not just about surviving a downturn, it's about having a fundamentally different business.
Well, what's fascinating here is that their dominance is structural. It's been built over decades, and it's constantly validated by their customers. They've been named the #1 national LTL provider for 16 consecutive years. They keep winning the Mastio Quality Award.
So they aren't just the biggest, they're demonstrably the best. But in almost any other industry, the best costs the most. How do they pull that off?
That's the magic. They're on this Mastio competitive value map in a place that should be impossible. They are simultaneously seen as the lowest cost operator while providing that premium service.
So they can charge a fair price for a better experience because their costs are just fundamentally lower than everyone else's.
Exactly. Competitors just cannot match that because their own cost structures are inferior.
Okay, let's quantify this superior service. The metrics really do form a barrier. We're talking about 99% on-time service. But the one that really gets me, the one that tells you everything, is their cargo claims ratio. In Q3 2025, that was an exceptional 0.1%.
0.1%. That tiny number is a huge deal for customers. Think about it. That massive reduction in risk, it creates incredibly sticky revenue. And you should know, that ratio has fallen from 1.5% back in 2002 all the way down to that 0.1% today.
Wow, that's just relentless improvement.
It is.
Which brings us to the structure. The analysis points to one key difference that makes all this possible. ODFL operates as a single, integrated, union-free organization. Is that really the secret?
Absolutely. That structure enhances productivity. It allows for flexible scheduling, multitasking employees, a unified protocol across the whole network. It's the core operational moat. When competitors have disjointed networks or complex union contracts, they lose the flexibility that ODFL has built its entire business on.
A fortress sounds great, but even the strongest fortress can't stop a macroeconomic hurricane. So how has this model held up against the sustained softness we've seen?
The current environment is tough. It's a prolonged freight recession. We can see it in the data. The ISM Manufacturing Index has been below 50 for 32 of the last 35 months.
And a reading below 50 means contraction, right?
Right. So the manufacturing sector, ODFL's lifeblood, has been shrinking for nearly 3 full years. That hits demand directly.
And we see that pain clearly in the Q3 2025 financials. ODFL reported a revenue decrease of 4.3% year over year. And the main driver was that volume drop we mentioned, that significant 9.0% decrease in LTL tons per day.
Precisely. And when volume drops like that in a high fixed cost network, you run into the problem of cost deleveraging.
So, to put it simply for you listening, less freight means their massive network is partially empty, which makes all those fixed costs feel disproportionately heavy.
That's it, exactly.
And that's what caused the efficiency drop. The operating ratio increased 160 basis points to 74.3%.
It's a classic sign of network underutilization. I mean, 74.3% is still miles ahead of the competition, but it's a long way from the record low OR of 69.5% they hit back at peak density in Q2 2022.
And it doesn't sound like things are turning around tomorrow. Management is projecting more pressure, with the Q4 OR increasing between 250 and 350 basis points.
which is higher than normal seasonal pressure. So yes, we're
Right.
still very much in the eye of the storm.
Okay, so if the market's punishing them on volume and the OR is taking a hit, why aren't investors panicking? This is where the story flips from defense to offense. It's all about the balance sheet.
That's right. Their financial strength is often described as bulletproof. And that's not an exaggeration. The company operates with net debt of approximately $20 million.
20 million, that's basically zero for a company this size.
It's effectively zero. Plus, they have access to a $400 million credit facility. This liquidity means they can weather any storm. But more importantly, it lets them keep investing counter-cyclically.
And they've kept their pricing power. Even with collapsing volume, their revenue per hundredweight still increased 4.7% year over year in Q3.
That speaks volumes. Customers are willing to pay a premium for that guaranteed service. They aren't just, taking bad deals to fill trucks like some of their peers are.
But wait, if volume is down, why are they spending money on share repurchases? They used over $600 million on that. Isn't that risky when the timing is so uncertain?
It's the definition of opportunistic capital allocation. They see their stock is suppressed due to temporary macro conditions, so they're buying it back. They used a massive $605.4 million for buybacks in the first 9 months of 2025. It's a huge vote of confidence in their own long-term model.
So this strong financial position is really just the groundwork for the biggest part of the thesis, the capacity advantage they are intentionally building.
It is. It's a true buy low, build low strategy. They are dumping capital into the network during the downturn to get ready for the eventual market turn. This capacity is their strategic weapon.
And we can actually quantify it. ODFL currently holds significant excess terminal capacity, estimated to be well north of 30%.
30%. Their normal goal is more like 20 to 25%, so they are way ahead. They're even holding new service centers in ready reserve.
And because they've built up such a huge buffer, they're now strategically pulling back on spending.
Right. They're reducing CapEx for fiscal year 2025 down to $450 million. This isn't a sign of weakness. It's a sign they're done building for now. They're just waiting.
And their readiness is amplified by this huge event in the LTL sector, the Yellow bankruptcy.
That was a game changer. Yellow's exit wiped out 308 service centers and about 10% of total industry capacity. And that capacity crunch makes ODFL's buffer an even bigger advantage when volumes do come back. They are ready to absorb that freight.
When liquidity returns to their network, what happens to the bottom line?
The effect will be, well, nonlinear. It'll be incredibly powerful because their costs are fixed. Once volume comes back, that new revenue drops almost straight to the bottom line. This will trigger powerful operating leverage, and historically that's allowed for OR improvements of 300 or more basis points during recovery years.
300 basis points is huge, and that leverage comes from their incredibly high incremental margins, right? Historically, between 35 and 40%.
Exactly. Once their fixed costs are covered, they're making 35 to 40 cents of profit on every extra dollar of revenue without needing to build anything new.
They've already done the heavy lifting. They've built the centers. They've kept the network humming. Now they're just waiting for the freight to fill the empty space.
That's the whole thesis in a nutshell.
Okay, so let's put it all together. The macro risk on one side, this incredibly potent operational opportunity on the other. How do we balance this pain now, gain later structure?
The bull case is strong. You have a proven superior operator, a huge market share opportunity thanks to Yellow's exit, and the potential for explosive earnings growth from those 35–40% incremental margins when volume returns. They are, without a doubt, the best positioned player to capitalize on the cycle turn.
But defining the reward means we have to define the risk. And the central risk is timing. The continued prolonged softness, the ISM below 50 for almost 3 years, means this is fundamentally a high-risk bet on when the macro picture will turn. It's a real risk. Management themselves acknowledge the potential for 4 straight years of tonnage decline if the economy doesn't recover soon.
And this raises a really important final question for you to consider. Given that ODFL says their direct variable costs are already at record levels as a percentage of revenue, meaning they're already running tighter than ever before, imagine the operating leverage. Imagine the potential OR improvement beyond historical levels if they achieve double-digit volume growth in the next upcycle. That foundation, plus all that new density, it just creates this massive, unprecedented runway for profit.
That high base efficiency point really does flip the risk-reward calculation, doesn't it? Thank you for sharing these sources and diving deep into the fundamentals of Old Dominion Freight Line. Risk defined, portfolio protected,